Hey there, traders. Todd Gordon here with TradingAnalysis.com and soon to be the wealth management company name. I don't think I'm going to release it yet, but hope you guys are doing well. Just want to give you a quick update as to what's happening there with the wealth management company that I've been speaking about here this year. Long story short, I punted on the test. I studied, I read through this book. I won't show the name. It's sort of a do it quick, sort of a get rich quick kind of study program. I read through all the content, did the exercises. I just didn't feel quite ready for it. So I got the more traditional Kaplan book. I'm going through this. I'm going to take it probably in the next 2 to 3 weeks once I get through all of this. So I just didn't feel adequately prepared. There's a ton of information in here. Again, it makes you feel, it gives me a lot of confidence going into the RIA world, knowing there's so many rules and regulations, so much structure to it, which I think as an investor, it's good. Other news, I'm getting knee surgery. This is going to be on Monday the 19th. I've had an ACL injury and an MCL injury for a long time. Probably I used to be a ski racer in college and do a lot of stupid things with skis on my feet, and time to pay the piper. So let's get to markets. What an unbelievable time to be trading, to be investing, and also to be launching a wealth management business, because holy cow, there's so many kind of crazy, meaningless cross currents happening right now that are distracting investors from really what's happening here. So I feel like, you know, the 20 years that I've been in the markets, I think it's time that I can help investors and help sort of guide them through all these crazy, insane kind of side themes that are really distracting from the whole thing. I mean, you've got the meme stocks, you've got the YOLO stocks, you only live once, short squeezes that are just unbelievable. Like Blockbuster Video was squeezed. I don't even know if you can find a Blockbuster anymore. The whole GameStop and AMC thing was absolutely crazy. You know what's happening is these younger investors, they're making their mark on this world, on this economy, in this market. And what's interesting is it started off on a Reddit theme kind of board. The guys getting together, and I think it's probably teens and 20s and maybe 30s who are
working from home.
And they have some disposable income now. They're getting some stimulus checks, and they're like, screw it, let's go to work. Let's put some money to work in these sort of beaten down stocks, and these are names that they know. Another distraction, unfortunate, a little bit morbid. I think you would agree, Bernie Madoff passed away at 82. I think he made out pretty well, only doing 12 years for what he did. So let's transition now to what really matters. So corporate profits. At the end of 2020, they were extremely strong. Two companies achieved something that's never been done before. Revenues of over $100 billion in a quarter. Unbelievable. Apple at 111 billion, Amazon at 125 billion. So now we're in Q1 earnings of 2021, and it started out with a bang. Financials put up some really strong numbers. JP Morgan saw record revenues, I think 32.3 billion. It was their highest ever earnings before tax and income. They put up a 19 billion, so unbelievable. Wells Fargo also put up the best quarterly profit. Goldman Sachs saw record revenues of 14.5 billion. And it was interesting in the Wall Street Journal here this morning, part of Goldman's profits was the investment banking fees. They increased 70-something% to 1.8 billion. And that includes all these new SPACs, or special purpose acquisition vehicles, and also these direct listings. Only 15% of the underwriting fees were these sort of new age direct listings that we'll talk about. The rest was the traditional equity underwriting. But these new age direct listings, there were some really big ones. We had Palantir, we had Roblox, we had a lot of other ones. So it's been certainly interesting. JP Morgan also said their underwriting fees tripled to over $1 billion. And the latest one was Coinbase, which just dropped yesterday, which I know is, if you've been following along, our work at Trade Analysis is very relevant. They were looking to go out at about 100 billion. They settled the day at about $85 billion in market cap. Unbelievable, larger than the NASDAQ and the New York Stock Exchange combined. Actually, I have to check that because I think it was with a $100 billion valuation, it's supposed to be larger than those two. And here's a statistic I threw out on CNBC, which is interesting. Total crypto coin market cap is $2 trillion. But the largest trading company, Coinbase, has a valuation of, let's call it, $85 billion. NASDAQ and New York Stock Exchange, which have control most of the total equity market cap, which is $49 trillion, have a smaller market cap than Coinbase. It's unbelievable. So let's talk about Coinbase. I've seen this before. We've been through several booms and busts with trading platforms. If you remember E-Trade, remember the talking baby, remember all the goofy commercials they had?
Or just go to E-Trade and save it. Boom.
We're drinking from the
Back when they wanted to charge you and I $20 a trade, which I paid for. I did. I was day trading on AOL dial-up. Paying $20 to do a $500 position in and then $20 out. Who cares? It was fun. It was the 90s. Everyone was having fun, right? I think I lost all my money in E-Trade. Yes, I did. But then we went to the FX markets when retail FX got up. And those bid-ask spreads, like you could drive a truck through those are massively wide. But these large brokerage fees that these guys are charging, creating a lot of profits. But the thing is, now we're getting it in crypto. And the retail trader doesn't know it. And two, maybe they don't care because the volatility is so insane. They're making so much money by being long and short this stuff. Maybe they don't mind. So take a look at this tweet that I sent my friend Peter Barrett. I outlined the markup. Coinbase wanted to charge me to trade $10,000 of Bitcoin. It was like, to trade $10,000, they want to charge me $206. That's 2%. It's insane. So look, I think when it comes down to this, don't love the stock. I hate the player. I don't hate the player. I don't like the player. I love the game. And the game is Bitcoin. So I'm still holding Bitcoin. I'm bullish on it. I sent the alert to our members back on January 21st to buy Bitcoin. The first buy point was about 31,500. That was hit. My upside target that I've spoken about on CNBC quite a bit is still 75,000. We're about 70 or about 63 right now, so we're getting close. If you don't want to trade Bitcoin, you don't understand how to get into Bitcoin, you don't want to pay the 2%, just go trade the ETF GBTC. In other news, this was interesting. I caught this in the Wall Street Journal. I don't think this got a lot of too much play. We saw the first round of hearings for a proposed $100 billion increase to the budget of the National Science Foundation. And what they're proposing is something called the Endless Frontier Act. So it's funding that is going to help us compete against China. Should boost chip manufacturing here, help build out our AI, our robotics, all sorts of programs that help us compete with China. President and Congress are looking to get behind these programs that will, again, level the playing field and reduce some of the predatory practices from China. That includes stealing IP, and I think most importantly, earmarking some of those funds to support R&D for American semiconductors, which that will help us alleviate some of the supply chain constraints we have right now so we can get more chips into the various products that we need, most specifically automobiles and smart homes and phones and every other thing. Everything is semiconductors. The real theme here is you got to pay attention to what actually matters, not all these sideline, attention-sucking headlines that really don't have an impact on what's really driving the markets. Okay, so here's to the markets. Saw a pretty good move up in technology today, NDX, and that's been the big theme that took us into the end of 2020 and that a lot have been carrying through into the first quarter of 2021. We're starting to see evidence, I think, that is going to change. We're not going to see this value trade come roaring back, which it's been trailing the growth trade and value, or your staples and your financials and some of your industrials and energy compared to more high-flying new age sectors like technology, communication, some consumer discretionary, and some healthcare. So let's take a look at the NASDAQ to start. And you can see that we've just recently broken above the February high in the NASDAQ here over the last 2 weeks. This is the weekly chart. I really like how the MACD is sort of gave us a divergence here as the NASDAQ made a higher high. MACD made a lower high, a little bit of a divergence, a little bit of a cause for concern, but then look what happens. Sold off a little bit, reset, and that's like a cocked gun ready to just explode there if we get the cross back up. So looking really good, and just to show you that, I mean, we just broke above that old high from when is that? February, and then if you just throw the SPX up, we were above the February high, which was here, back in early March. So, the NASDAQ is about a month late there. So from an Elliott wave point of view, let me show you where we are. This is one interpretation the team at Trading Analysis is following. I'm not doing as much Elliott wave anymore. I'm really relying on the team, Bennett and Alex and Terry, to do that for me. I'm focused on other things on the portfolio management side. Those guys are so good at it. I'm not even the best one at the shop anymore at Trading Analysis. I used to be. It's not the case anymore. So, this is one interpretation on the daily. Holy cow, if we're looking at a orange 1 and then down in 2, that would be an ABC. I guess that'd be a flat correction there in 2. Another move up, smaller degree, blue 1, 2. We could be in for a pretty significant wave 3 move up. And that, if we're going to a wave 3 NASDAQ move like that, that is by far confirmation that we're not rotating back in on a year-over-year basis into value and out of growth. And I think one of the bigger things that is going to determine that are interest rates. And if we go over there to the TNX here, there we go, 10-year yield. I think a big cause for concern was the move up in yields, whether it be inflationary concerns because the Fed is pumping so much money into the system over the last 12 or 14 years, and then on the fiscal side, what the federal government's doing in terms of stimulus is going to cause massive runaway inflation as we're reopening from COVID, or there's a variety of other reasons that could say that we're going to have runaway inflation. So inflation would equate to interest rates moving up, bonds moving down. If the value of the dollar, your coupon payment now, let's say it's $100 coupon payment compared to an inflated dollar 20 years down the line, that same $100, you don't want that payment. So you're going to sell bonds, which would drive interest rates up. That will then bring new investors into the bond market and say, okay, I didn't want to take a bond at 1%, take it at a 2.5%. That's what makes sense. But if you look at the move here, this is a weekly chart. We went right up to the 200-week moving average on the 10-year yield, which is very important. Went up to about 1.748. And you can see this week we've backed off sharply. This is the weekly. Here's the daily. Big move down, close right in the lows. This is a 30-minute chart. That's pretty significant there, okay? And the other reason is if interest rates are going to go up, it's a hard argument to make to say that, oh, I want to hold technology stocks with the promise of profits, massive profits at some point down the line where if interest rates are moving up on fixed income investments, you could say, well, maybe I'll rather take a higher 2, 3, 4% yield now, compound that in the time that the tech stocks will hopefully deliver on the promise or indication of profits from their unbelievable innovations that they're putting forward. So that's what's going on there. And the one thing I want to finish up with here is take a look at So these are relative rotation graphs, and what they're doing is they're looking at sector and industry and market rotation around a central benchmark, which is the intersection of the XY axis, which is the S&P 500. I've got a benchmark to the S&P 500. And as they rotate in a clockwise fashion, down here is the lagging quadrant, up here is the improving, this is the leading quadrant, and then down here is the weakening. So usually markets rotate on a clockwise basis in and out of favor. And the point of this chart, this is a monthly chart. Okay, if we start back here, let's go back to like 2000, you can follow my slider up here, 2016, 17, 18 here, you can see that they are rotating around the central benchmark here, which is the S&P. The other thing I draw your attention to is look at this circle right here. This is a standard deviation circle. Basically, you expect 68% of the occurrences to fall within there, and if it goes outside that 2 standard deviation, it's considered to be unusual and fairly extreme. That's all you need to know about that. But basically what you're seeing here is you're seeing Dow Jones large cap growth, Dow Jones mid cap growth. So we've got large cap growth in teal, mid cap growth in orange, large cap value in green, and mid cap value in purple. And you can see the guys are kind of rotating around, and you can see the 2 standard deviation circles kind of stretching out. They're going around here. Okay, so now we see large cap growth rotating up. That's a good sign. Mid cap growth rotating up and to the right. That's a good sign. Let's see what's happening. Okay, looks like mid-cap growth started to take a dive while large cap started to move up. And that was the first thing that I found interesting. That was a pretty good divergence between the two. Usually follow purple and teal. They usually go together. See that? But then look what happens here. Look at teal. Boom. Big rush into large cap growth, and that's right around March 2020. And in fact, it happened even back in December 2019, about 3 months before the pandemic hit. And the point of this is, look at how far to the right large cap growth went. It exploded outside the 2 standard deviation circle, and then mid cap growth followed behind it. Okay, and then we can throw small cap growth in there too, right there, and that's in orange. No, it's not really orange. I guess that's white. Okay, so what happens is, okay, so we have small cap growth, mid cap growth, and large cap growth, all to the right, which is strong, and the further up and to the right, the stronger they are, okay? The point that I'm going to make here before we switch is, look how small the deviation is around the central benchmark. Then all of a sudden, watch this move here as we get into 2019, the end of 2019, watch large cap growth. Boom. It ripped up and to the right. I don't think you're going to see a full rotation from the weakening into the lagging, into the improving, back into the leading quadrant. I think what you're going to see is something like this. Watch this back in 2018. Watch the teal down and then boom, right back. You can do that. You can rotate and go right back up. I kind of think that's what's going to happen again, okay? And then if we get down to the weekly, here's what's happening. We've got mid-cap value and large-cap value out to the right. But keep in mind, this is a weekly chart, much smaller. Okay? All right. So what's going on here? We've got large-cap growth and mid-cap growth in the weakening, lagging quadrant down here. This is lagging. But the other thing I would draw your attention to is the space between the dot. Each one represents 1 week. It used to be very far apart between each one. They're getting more and more compressed. It's like losing relative strength in an RSI indicator. The market can continue to go up, but the rate of change decreases. I'm thinking that on the weekly basis, you're going to start to see large cap growth start to rotate up, and that's going to allow back on the weekly chart the hook to happen out here and possibly go back up, okay? So from the monthly, let's get down to the daily, and then you're going to see this. This is just, I mean, just all day long, the last couple days, all large cap growth. Mid cap growth is large cap value, and mid cap value are falling out of favor. So if you've made it this far, I appreciate it. A couple things on data which kind of underline the point that I'm making. We just saw retail sales came out at like plus 9.8%, unbelievable. I think that one of the biggest headlines was, one of the biggest components of the push up was bars and restaurants. No surprise there. People are flush with cash, ready to get out of their damn house and go enjoy some nightlife. So the other part is we saw CPI recently, which wasn't all that bad at all. I think the headline number was 2.62%, and then the core, which strips out food and energy, was like 1.65, so not bad at all. Take a look at the long-term downtrend in CPI. It's been heading lower since the early 80s, which is when interest rates started dropping, which is when the birth of the bull market. Remember 1982, I think, was the breakout in IBM, which is what this technological deflation theme that I'm talking about, that Cathie Wood has mentioned several times in terms of technology applying deflationary force. As companies are more efficient, they do so on a more cost-efficient, higher operating margins, and that's all that. So as long as inflation stays under control, we should be good to go. So other than that, cheers. A little glass of wine. I do have to edit this video. This isn't a great bottle. We'll save it for after the surgery. But wish me luck on the surgery. I'm making a bigger deal than this than it seems. But here's what happened. I tried to not go on YouTube to see an ACL surgery. Oh my God. Like, I thought it was just a couple little snips and, you know, you're fine and it ties things up and you're good to go. This thing's invasive. They're like pounding away at my tibia and fibia, drilling. They're gonna take a piece of my quad tendon, cut it out, and then drill it into my knee, tie some things up, throw some duct tape in there. Kind of wish I didn't look at that. Thanks, YouTube. Anyways, if you guys had it, let me know. ACL surgery, let me know how it went for you. Let me know what things you did right, things you would have done differently. I appreciate it. And see you guys. I don't know when I'll do the next video, but good luck trading. It's fun out there. Stay safe and make a lot of money. See you guys.